It is a clearly, openly manipulated, top-down, non-fundamental G5 major currency. Unlike a meme coin, it has implications on things like the risk-free United States Treasury.
Yields are on JGBs are starting to come back up. At the same time, we're seeing weakness in the currency.
Ain't that a problem? Japan has a magical ability to defy economic gravity for longer than we think. That's why they're called widowmakers. Is it sustainable? No. That's why people put the trade on. Is it more sustainable than people think or their trading time horizon? Yep. And that's why they become widows.
You could open up a swap line with the Fed and just shore up yen on your balance sheet when you use these fresh USDs to hold the line.
Certain central banks, the major ones, there's an implicit. It's like 2008 and like all the investment banks, but done at sovereign level. Too big to fail countries. Who's going to bail out government of Japan? That's what the moral hazard is. That's going to set a precedence for, okay, other governments, okay, United States, if you want to run deficits, it's going to be all good because look at what happened in Japan. That's the moral hazard that they're relying on. It's that put option. This is what I'll say. Dollar yen 300 is more likely than dollar yen 200. The shorter term, though, like you saw how fast dollar yen moved. 155, 158, 160, and then smacked back down. Each Yentervention is getting them 5-handle drop in USD JPY. That's fine if you're trying to like protect the 140 handle. But starting from 160, you drop it down to 155. They have to just keep hitting it down. The worst thing that could happen is if they do a Yentervention and it fails. You get dollar yen to fall, but then comes right back up. Because if that happens, then they're going to throw the fucking kitchen sink at it. Oh my god, this doesn't work anymore. The yen really gets destroyed. USD JPY is on autopilot upwards. Risk of having a failed intervention is much worse than the current slow death JPY because it's do or die.
Do they have access to the exchange data and then they can try to just basically stop loss hunt?
People need to give them more credit as like currency traders. They have more information than anyone else would normally legally be privy to. And what they're doing is what I call aggressively waiting for the Powell pivot, for the Lagarde pivot, whatever flows back in. In the meantime, if they have to spank USD JPY down, no other choice.
I really wanted to dive into this because for our readers, right, like Japan is an extremely interesting case study. They've had, they're the forefront in experimenting in monetary policy, and they've been battling essentially decades-long deflationary forces. And this all happened, due to a 1980s credit bubble that popped in 1990. Their stock market and real estate market collapsed. And in the wake of that and that subsequent, severe recession and deflationary force that kept pushing on the economy, they started experimenting with new forms of monetary policy. And so the first one was QE in 2001. And then more recently, in the wake of the financial crisis, they started doing yield curve control. And I kind of want to start there, right? Like, what was so, crucial and important to understand about yield curve control, and how did that change the Japanese bond and stock markets and lead to where we are today?
Sure. Well, so first of all, there's also the negative rates part that preceded yield curve control in January 2016, yield curve control in September 2016. And the reason I mentioned that is because this is just totally my view. But so I was on the trading floor at the time when all this was one by one. This is under Governor Kuroda when this was unleashed, and like a 2014 Halloween day that was supposed to be a sleepy BOJ day. Bank of Japan fires off a massive bazooka of QQE, stepping up to 80 trillion yen a year in monetary base expansion, all that kind of thing. And then what happened was that in January 2016, about a week before the Bank of Japan cut rates into negative territory, Governor Kuroda was asked point blank at the time, like at Davos, the media, all that, like, is Japan, what about Japan? Is Japan going to go negative? And he was explicitly said, like, no negative rates in Japan. Like 5 days later, negative rates in Japan. Shocking all again. But that time though, so he was known for this kind of like shock and like kind of getting the most bang for your yen, like just catch markets off guard and shock them. But this time, that easing response in markets, you saw. This is when dollar yen was like meant to go higher. Like they tried to get to go higher. Dollar yen rallied, the Nikkei rallied, JGBs rallied, JGB yields fell. But then that only lasted for like like an hour and a half or so, maybe even less than that. And then it kind of just peaked out. Dollar yen started to peak out and then started to fall. And then it fell just one direction down for the next 6 months. And on Brexit Day, it went from basically above 120 and it cracked 99 into the 99 handle on Brexit Day later that year. So that was kind of a massive policy mistake that was very evident like 5 minutes after they released it. But you can't take back policy once you made it official. What are you gonna do? Like say like, oh, never mind? No, right? So they have to stick with it, and they can't exit it unless the financial conditions for which they've implemented it supposedly change. And if nothing changes, they're stuck with it. Otherwise, they're going to lose their credibility. So if they remove it, then people are going to say like, why are you removing this? And then because they lose their credibility, whatever they replace it with is not going to have holding fire. So that's why they're kind of stuck with it. So later that year, yield curve control comes. I think that yield curve control came as at least definitely in part due to this policy failure and having to like kind of not erase it, but cover that up with something else so that that's not like the lingering thing for the next several years as yield curve control was. So yield curve control was basically just two components. It's the negative rate at the front end, the policy rate. And then they took the 10-year JGB yield, the longer end, which is supposed to be a market rate, and they made that a policy rate. And they essentially were going to pin that to around zero. And that around zero started to kind of form like these upper and lower trading bands that would kind of widen out, and that's basically how that worked. This is the first central bank to turn the long rate into an actual policy rate, and that was all fine and dandy, and that was in the pursuit of inflation. Of course, like all of this was in the pursuit of getting out of deflation and 2% virtuous cycle of growth and inflation. And that's all fine and good, unless global yields start to blast higher. And that's what's happened in 2022 due to inflation and monetary policies around the world. And that was happening. And as that was happening, JGB yields are not immune to global bond sell-offs. And so they started to go up. Bank of Japan started to cap rates at whatever the yield curve control level was, be it 25 basis points, 50 basis points, whatever it does. But when you do that, and like US yields and European yields and all that are just kind of going up by hundreds of basis points in a very short amount of time, yield spreads just blow out. USD JPY, EUR JPY basically just also just skyrockets upwards, and that basically means the yen gets crushed. And so that's what's been going on.
And so their program of yield curve control, right? This was kind of like aimed at revitalizing their economy and maybe even revitalizing their stock market. Was that successful at all? I know that recently, right, the Nikkei has finally broken out of its to new 30-year highs, but 2016 was 8 years ago. Like what took so long?
No, I don't think it was successful because first of all, when Prime Minister Abe and Governor Kuroda launched Abenomics, when they started that was in 2013, and they said 2% inflation in 2 years. It has been like his tenure was 5 times longer than that, and they did not achieve that. And the only reason that Japan has inflation now is not because of yield curve control, which has been in place again since September 2016. No inflation was generated from any of that. Inflation happened in Japan is because it's global inflation. And Japan's inflation is not nearly as high as the other developed, markets. So, no, I wouldn't say that it necessarily worked. And I would also argue that the removal of yield curve control, because that didn't cause this inflation in Japan, why would the removal of that solve the inflation in Japan as well, right? And so even though they had been lifting the bands and now they're the upper bands of yield curve control, now it's just completely gone altogether. That's more of a function of regaining market, not stability, market functioning, or reducing market dysfunctioning as a result of such concentrated buying and suppressing, the 10-year tenor of JGBs, having a very weird yield curve control shape, which I know that you've talked about and covered as well, owning over 100% of some issues of certain JGBs, which is possible because they own the entire thing and then they lend them out again. And so on paper, they own over 100%. It's insane. 8-year and 9-year JGBs yielding higher than not just 10-year JGBs, but higher than 10-year JGB yield cap. Like, it's just insane. So they had to do something. So they lifted yield curve control higher, and by doing that, that caused an insane amount of JGB sellers to come in. So that kind of backfired too. And so now they just want to just free themselves of being imprisoned in this policy, and it looks like they did actually rip the lid off, the band-aid off. And so far, so good, although JGB yields are creeping back up towards that used to be upper 1% band, but we'll see what happens. But no, to answer your question, no, it didn't work, and that's why they're getting rid of it. But they're not going to frame it like it didn't work, and that's why we're getting rid of it. They're going to say it worked, and that's why we're getting rid of it. But it didn't.
It worked so well, we have to end it, right?
Exactly. No, but that's what their communication is. Like, it's the all these policies. The last in March, when they're like basically saying, you know, no more negative rates, no more ETF buying, because all of those things did their job, and so that's why they're no longer needed. Really. Like that Nikkei is not breaking all, like, you know, all these like these record highs because of BOJ buying ETFs. BOJ didn't buy any ETFs. It was all foreign capital. Like what and you know, like things like, we could get into the currency obviously, but like the currency getting destroyed, that might have had something to do with like their choose, rather than this externally driven inflation that the entire world. It wasn't BOJ policy and yield curve control that suddenly kicked in on the 6th year. So
yeah, no, the Bank of Japan, you know, they've turned their they've created a monetary upside down, right? I covered this as well in another piece. Like, they own over 50% of the entire JGB bond market. You're right. Like, they own, 70, 80, over 100% of certain tenors. They've been playing with this experiment for almost a decade, and they have not much to show for it. I mean, first they started off with a 25% cap, and then they moved it to 50 or 0.25, 25 basis points. Moved it to 50 basis points.
10%.
10
basis point, yeah. Then to 20, then 25, then 50, then 100. Then
100. And then they just finally ripped the Band-Aid off. Why do you think they finally decided now? Like, what is it because of the carry trade that's been opening up? Do you think that's part of the reason why they decided to, in March of this year, take off the yield curve control bands?
In March of this year is when they got rid of the negative rates. They got rid of yield curve control upper band, explicit upper band, in October 2023. So like Halloween 2023. If you look at a chart, 2023 before August, 10-year U.S. Treasury yields in white were kind of capped at like a very like arbitrary, a little bit above 4% range for the first half of the year. I don't know if anyone really noticed that. And then for some reason they just burst out suddenly at the very end of July, and then they subsequently rose, about a full percent up to 5%. And then they about faced, and then they dropped after that. Whatever could that be due to? Why did that happen? Well, you kind of have Bank of Japan policy also occurring. So those lines right there, that's yield curve control. That's at 50 basis points. Okay, that's what's been capping 10-year JGB yields. That's what's also been capping global yields, including 10-year U.S. Treasury yields, because Japan or JGBs are the world's duration anchor. You're talking about manipulating or suppressing yields on the world's largest foreign fixed income investor. And so at the end of July, they suddenly shock lifted yield curve control bands from 50 basis points to 1%. And when they did that, with 10-year JGB yields already at like pressing up against that like upper limit, of course they're going to jump higher, and jump higher they did. And so did 10-year U.S. Treasury yields, breaking out right at that moment. And then you see this kind of glide upwards for 1%, but not like this, elevator up. It was this relatively orderly sell-off or orderly rise in yields. And that during that period, that was when Bank of Japan new governor Ueda had introduced this, what he's currently doing, this policy of what I call yield curve control, attempting to regain control of their own yield curve control policy back from the hands of markets, get it out of stop being like hostage to like defending like specific levels, throwing unlimited JGB purchases to hold like the line at a certain level. They wanted to just reclaim that back, and they're doing that with purposeful ambiguity and policy uncertainty, so that no more red lines in the sand, no more defined lines to have to defend, and all that against widow makers or widows or whatever. And so that August to Halloween, Bank of Japan meeting at the very end of October. During that time, that's when they were just very unpredictably in markets using different kind of tools and ways to like unscheduled JGB buying operations, this and that, and that's what it did. That activity that didn't necessarily push yields, global yields or JGB yields higher. The forces of markets were pushing them higher anyway. They were just there to kind of suppress it and to try to make them not explode in a volatile, erratic fashion higher. And so that's what all that activity was all about. Then at the very end of October 2023, they, like you said, ripped off the Band-Aid. No more yield curve control cap. And you would think that that would make yields in Japan go to like, I don't know, like 50% or whatever the hell the market rate is for the world's most indebted sovereign. But you see that didn't happen. But what actually happened was yields actually did jump that afternoon. But the very next morning, the Bank of Japan stepped in with another unscheduled JGB buying operation at 12:30 p.m. in Japan time, and that was basically the top tick for JGB yields, and that was the turnaround point. That was when the massive shorts that were on JGB futures started to cover, and they said, all right, look, we made a ton of money on the short JGB market, and we have no idea where the new line in the sand is. Like, short squeeze, short covering, begets short covering, and then you see just like yields fall back down again. So that whole move, that was very much, you could call it a Fitch downgrade, or you could say that it was the world's largest fixed income investor not being suppressed artificially by the Bank of Japan, or the Bank of Japan allowing for a doubling of yields suddenly out of nowhere. But to answer your original question, the reason that they're doing this, that Governor Kuroda is doing this, or Governor Ueda is doing this, is because Governor Kuroda, he could not during his tenure walk back or unwind any of his policy. These are, when you own 50% of the or more of the JGB market, there's no unwinding of that. You've already destroyed liquidity in the market. Like, what are you're gonna sell JGBs into the market? So like, there's nothing that they can do, and they can't admit that. And it's not like for ego or anything. It's because you can't, like, it's central banker 101. Like, you can't say that our policy had been a failure. Like, we're very sorry, bow your way out. Like, no, so he was stuck with that. But in comes a new governor. That's the perfect opportunity to say, thank you, Governor Kuroda, for achieving this 2% inflation that the rest of the world had also undergone. And now it's time for a new era. And so that's how they're framing it. And that's this like first kind of year is the only time in which Governor Ueda's basically given like allowed to change policy without making it look like everything that they had done from 2013 forward had been a massive waste of money and all of that. And so they're trying to unwind that, and they're trying to regain policy control back. But at the end of the day, my view is that they're just going to find his inner Kuroda, as in, like, JGB yields are not going to be allowed to trade in market rates. Like, the Bank of Japan is not going to start selling their half stake in the government bond market into a market that they themselves destroyed with no liquidity. There will be some form of like yield curve control or JGB buying, maybe not packaged and marketed that way, but it will exist in some form or another. It still does, for that matter, right? So, but yeah, I think that that's what's going on right now in terms of that policy.
Yeah, you're right. I mean, they essentially, not kind of, have killed their own bond market, right? I was reading articles in 2022 and 2023 from Bloomberg saying, hey, like, certain tenors of JGBs haven't traded at all in a week. Even popular ones on the run, 3-year bonds, 5-year bonds haven't traded at all, 0 trades. And that's a record for how many days that's actually happened. If your bond market isn't even trading with your own dealers, what does that say about the health of the system, right? And the question is, okay, so they can't really allow yields to rise, right? Because the Ministry of Finance and the Japanese government itself is caught in this debt trap. So if they allow yields to normalize with the Fed, they'd be paying if they actually let their entire with the Fed. This would be insane. But if they allowed their entire debt to be refinanced at the rates of the Fed, they'd be paying 13% of their GDP in interest, and so that's impossible, right?
They would be paying well over 100% of their budget to in that. Yeah, so they would have to issue more JGBs to cover that, and then therefore more and more and more. So yeah, it's not possible. The math is impossible.
No, exactly, and that creates that doom loop that we've talked about, right? Like if you are raising rates into this environment where there's no demand for your bonds and the interest expense explodes, you have to issue more bonds, which means the rates would theoretically go higher. So then you have to have the central bank monetize that by running larger and larger QE programs, which is eventually inflationary.
Yeah, well, I wouldn't say there's no demand for JGBs. Like at the front end, they're actually like foreigners own a ton of JGBs, like percentage wise of the outstanding, but that's because of certain trades like cross currency based swaps, all that kind of thing. But like in terms of like the longer end, like Japanese life insurance, and like pensions, all that, like they have, they're by regulation they have to own, a certain proportion of their portfolio has to be in JGBs, and they could always like kind of regulate that to be more or less. But so I mean, it's not real demand, it's forced demand, I guess. But but I hear what you're saying though. Yeah, like who the hell wants to buy a JGB? Like they're gonna default at some point probably, and so the question is on who and how. And so it looks to me like they're probably going to default on themselves, as in on the Bank of Japan. And then that doesn't really hurt anyone though, right? So like I was just saying, like the Twitter Spaces that you and I had, well, I think I mentioned this, like when you see articles about Bank of Japan's mark-to-market losses since they started to increase the yield curve control caps, but they've taken like a $70 billion like mark-to-market losses on their JGB holdings. But then the way I read that is, well, what they actually did was by getting it out of the hands of the private sector investors, they say the private sector investors like sidestepped $70 billion mark-to-market loss on their JGB holdings. And it's now been transferred over to the Bank of Japan balance sheet. So I'm not saying that that's moral or what I'm like, all that aside, I'm just saying like that's how I read that, and that's how I kind of see it. I don't see there's no tapering that's going to there's no like unwinding back to they've gone too far. It's gone too far at this point, right? So
and any mark-to-market losses they have, right, they can just recapitalize themselves. And so they're not a hedge fund, they're not a family office, they're not an individual investor where losses would actually matter to that extent, because they can always paper it over and they can absorb it. Yeah. So I wanted to also talk to you about the carry trade, because that's been a huge theme with this, understanding the price action of USD JPY. Can we go over like what's a carry trade? What are some examples? I know that you and I were talking beforehand on AUD JPY and the price movement before the financial crisis. But yeah, what is a carry trade and how does it unwind?
So carry trade is like, it's one of those things where there's the definition of it is like everyone's got like a very different definition. It's very broad. I guess the way that I would define it, probably you as well, broadly speaking, is it's it's exploiting interest rate differentials. You're selling a currency with or you're borrowing from a currency with a very low interest rate like Japan or JPY, and then you're investing in a higher yielding currency, and that difference is your carry. That's your kind of your return. That's in a nutshell. That's basically what it is. And there's so many different kinds and forms of and ways to do it. There are hedge funds that use insane amount of leverage to do it. There are like individual investors who use that as a very look at it as a very conservative sort of method of income. You're credited nightly, as long as that yield spread remains kind of intact, and you can have stop losses and all that. Whereas it could be extremely risky in terms of like if you're levered up, and a lot of carry trade, it's like if it's seen as like kind of passive, like an automatic income and trend income, if you will. Those proceeds are used to then fund things like risk assets, like what you were talking about. What was like this RBA, the Reserve Bank of Australia, had published a paper about how the Japanese had been engaged heavily in the carry trade for AUD JPY, Aussie, the Aussie yen rate, because at that time the RBA, Australia's central bank, had interest rates that were like 4 or 5%. This was by the way 2000, leading up to the 2008 financial crisis. During that time, I guess in like 2000, like the 2004, 5-ish or so, up until 2008, the Aussie yen carry trade was put on massively in size, not by Japanese retail, as well as like institutions, but Japanese retail was actually very heavy in it, and such that that even kind of trickled out into funding a lot of long positions in these like crap subprime mortgage, like subprime CDOs, and like all those products that kind of blew up. But and then you saw this spectacular unwind of the long AUD JPY carry trade in between when Bear Stearns and Lehman blew up. So this is like in June or July of 2008. Like the Aussie dollar fell like almost like got cut in half, like 40% or so within like 1, 2, or 3 months, because of this like massive unwind, and therefore JPY appreciated and all that as well. But so that's kind of in a nutshell what it is. And there's so many different ways to do it. It could be completely like spot currency absent in ways to structure it. But the yen is always kind of seen as the go-to for the funding leg of the carry trade, just because of the fact that it's not just because rates are, because money is free to borrow in Japan, not just because of that, but more so also because carry traders, they don't, it's not like the enemy of carry traders isn't necessarily the yield spreads to compress, but it's yield volatility on either side. So if you're like long AUD JPY carry trade, so you're selling JGB yields or JPY rates here at on the floor percent rates, and then like let's say Aussie yields are at, let's just say 5% or whatever. If you're levered, if any of them if you see volatility in any of them, you could just get a margin call. So your enemy really is just volatility on either side. So what yield curve control does for Japan is it pins the JGB yield down, to zero. But the zero thing doesn't really matter as much as the fact that it's pinned down. And therefore, like, half of that leg of volatility has been kind of, are magically erased by monetary policy. Yeah. And then what got really interesting was in the midst of COVID, basically you have, QE forever and all that kind of thing. And that rescued markets and that shot markets up. Yeah, fine. I don't disagree with that. What also happened, however, though, was that the RBA, the Reserve Bank of Australia, became the second bank to also implement yield curve control alongside the Bank of Japan. Now, granted, they were doing it on the front end. They were doing it on like 2 and 3 year Aussie rates. But nonetheless, that was another major central bank that had entered yield curve control land. And so now, if you look at the AUD JPY carry trade, you now have, and by the way, at that point, the RBA had cut rates basically down to the floor as well. So like people would say, like, well, how was there a carry trade? How is there any yield, differential to exploit between, JPY rates and AUD rates? Well, that's like I said, it's not just only about the yield spread. It's also about the fact that if you have, a complete lack of volatility, if you have standstill yields, then you can lever up like crazy, and you would get returns, and it would, by policy, both sides have dampened volatility, and that's exactly what happened. You have both the BOJ and the RBA pinning down the rates by policy, and that invited a ton of the AUD JPY carry trade back. That was instituted in the like mid-March of 2020, and basically carry traders just went long the AUD JPY carry trade. They, like I said, they take their proceeds and they look and they invest them in risk assets. They take a look around. They saw SPX had just basically plummeted, and so they went long SPX, and that's why you see Aussie yen and this is a chart of Aussie yen and E-mini futures that are very, very, very
which is
highly
S&P
correlated.
500, S&P 500,
Yeah.
right?
Yeah. Yep. S&P 500. But I mean, it's the same with any major GM index at this point. But they're very, very highly correlated throughout 2020 because you had this dual yield curve control happening, at the same time. See, there's RBA's yield curve control, SPX bottom, and then you kind of see these moments like that June FOMC, and then SPX would just plummet after that, and then July FOMC, and then SPX would plummet after that. At those times, that was basically everything. Basically, up until that was kind of AUD JPY carry trade, correlated and very much intertwined. And then that kind of run up to June FOMC, that's when you see actual activity reflected in markets for the whatever's going on with FOMC and expectations of and things like that. But otherwise, left unattended, they would just kind of a lot of them are systematic. They would just be systematically kind of driven together. And then that last one, that SPX top of this Australia GDP, minus 7% recession. This is the first recession that Australia has seen in 30 years. Everyone knew it was going to be a recession, but it's much, much worse than expected. And then that's when that day AUD took a very sharp drop, and SPX had a really sharp drop that day. So they're very much intertwined with dual yield curve control happening. And then eventually Australia threw in the towel because they could no longer fight the front end of the bond markets. The front end yields and Aussie yields were just blowing up in their face, and then they threw in the towel and they said, we are voluntarily choosing to end this because it worked. Like, very similar to what Japan's saying right now. And everyone knows that was this is nonsense, but they dabbled in it. Wasn't for them. But for that time period, we did have a moment of, dual yield curve control, and you got carry traders to come in and put that on in size. But that's that kind of a very unique scenario. Otherwise, there's the carry trade of most recent or current, where again, Bank of Japan has very low yields. Their yields are at zero. The policy rate's at zero. The FOMC has above 5%, policy rates, Fed funds rates, and so you have this a massive opportunity. And so the carry trade is very much alive and well. And who knows what that's funding, but the carry trade is basically, it doesn't exist in isolation. Like a lot of if you get a margin call on it, you're going to have to liquidate some other assets and this and that. And that's why there's so much kind of correlation, especially to downside and sharp downsides in a cross-asset basis.
Got it. Yeah, that makes sense. And the carry trade, I mean, I can even see it be as simple as, and I've heard of people doing this in Japan, of, you can get a loan in yen and then go to the Forex market, sell the yen, get USDs, transfer to US bank account, and buy US assets if you want to make it that manual. Right? It's pretty simple. It's just borrowing in one currency, and it becomes that synthetic short. And that's really interesting how you're showing that how correlated it is to the stock market. It reminds me of Dollar Milkshake from Brent Johnson. I'm sure you're familiar, of the dollar basically draining global liquidity, and so that seems like that's what's happening now with higher US rates, and that yield differential between the US and Japan.
Yeah, and dollar strength and all that. The one thing I will say about just to get back to what you just mentioned about Japan retail and all that. Some might argue that the carry trade doesn't apply if you're a Japanese investor, because I'm a resident of Japan. We're naturally long the yen, so we're not necessarily borrowing to short the yen per se if we're doing it out of Japan, which thereby makes that entire RBA paper about the Japanese retail investor, carry trading and funding, subprime mortgage-backed CDOs, kind of out. How I feel about that, I don't really know. But what I will say is this: Warren Buffett is famously kicked off the Nikkei rally from 2023 and this spectacular rally that has the Nikkei finally break through its 30-year bubble highs and all that. What he did was, Warren Buffett, that wasn't when, like, last year was not when he first started investing in these trading houses. And what he's invested in Japan is 5 of the largest trading houses. And for those who don't know, trading houses in Japan are basically, they're like these massive conglomerates. They have, each of them have like over 1,000 subsidiaries. They own like convenience stores and everything. But because they're so big and complicated, by and large, what they are commodity plays. The shares move more or less up and down with commodity prices, because they have a lot of exposure to like global commodities and all that. So he first got long in 2020, in August of 2020. But what he did was he actually borrowed and issued Berkshire Hathaway yen-denominated bonds in order to fund those equity holdings, those equity stakes in those 5 trading houses. In other words, what he did was Warren Buffett put on a brilliant carry trade, a brilliant macro trade in August of 2020. He went short bonds, long commodities before interest rates and commodities skyrocketed. And so that's a way of, again, there's so many ways to define and look at it, but he's got a carry trade on too. So yeah, that's again just another example of that, right? But brilliant macro trade, brilliant. But yeah.
Yeah, I didn't hear about that. That's genius, right? Because he's essentially getting cheap funding and then using that funding to buy valuable stocks at good prices,
and he's borrowing in yen, and so therefore there's a ton of demand, because even if there's a premium over JGBs are nothing, so he's still issuing bonds at sub 1%, but Japanese investors at the same time are happy to take that extra yield for something, and Berkshire Hathaway is arguably more creditworthy than the Japanese government anyway. So there's appetite for it. There's willingness for the issue. It's a very kind of happy marriage. And then he goes long in Japanese assets. He doesn't really have currency risk either. So it's just a very kind of brilliant structure all around.
Yeah, that's genius. There's no wonder why he's the Oracle of Omaha, right? One of the greatest investors of all time. So I guess then what happened after December? So we saw the chart where the yen, the yields on the JGB started rising all through after August, after that late July meeting where they ended yield curve control, or they started to move the bands up to 1%. We go all the way to the October meeting. They take off the lid off this thing. Then there's a massive short cover all the way to December, and now yields on JGBs are starting to come back up, correct? And at the same time, we're seeing weakness in the currency.
Ain't that a problem?
Yeah.
Yeah. Well, you have a choice. You can defend the currency, you can defend the bond market. Now, technically, and I've heard you make this argument before, that you got to pick one or the other, and you're right. However, Japan has a magical ability to defy economic gravity for longer than we think. That's why widows are made. That's why they're called widowmakers. Is it sustainable? No. That's why people do put the trade on. But is it more sustainable than people think, or their trading time horizon? Yep. And that's why they become widows. So currently, Bank Japan and the Ministry of Finance, I wouldn't say that they're at odds, because all people think that they're at odds because it's like the Ministry of Finance, who oversees the currency, the currency is getting killed because the Bank of Japan has this like abnormally low rate environment, is sticking to that, and these yield spreads are blowing out, and policy differentials and all that kind of thing with U.S. and other major central banks. And so if they just raise rates like normal people, then we wouldn't have the yen getting destroyed. But you can't really raise rates because, again, the Ministry of Finance is the body that has to issue JGBs at ever higher interest rates, and they don't necessarily want that either. So it really is up to kind of the Ministry of Finance. They're the ones who are going to play, who are affected by both, right? They mine the currency, but they're also JGB issuers too. And it seems like the issuing of JGBs is not like an option that they can opt out of. Or to have like it varies like sharply higher interest borrowing costs to happen to occur in Japan is not really fathomable. So that's why you're getting the currency destroyed, and that's why the most indebted country in the world still gets to borrow for 10 years out for five times cheaper than the risk-free United States Treasury gets to borrow for 1 year out. But they're also kind of doing yenterventions and all that, and they're doing the impossible. They're doing the the supporting of JPY as well as the JGB market. And I think that what they're doing is what they did kind of successfully in October of 2022, where they basically are just doing what I call aggressively waiting, right? They're aggressively waiting for the Powell pivot, for the Lagarde pivot, for aliens, Martians to land on Earth. Like so whatever gets like flows back into like bonds and yields to drop and all that kind of thing. But they're just aggressively waiting because there's nothing more they can do. And in the meantime, if they have to like spank USD JPY down, I mean that's what they're trying to do. It's what they feel is that they're like no other choice, because they can't let yields on JGBs go that much higher. So yeah, it's a very interesting sort of thing. And they actually did step into the market twice in 2 days this week, and they did about 9 trillion yen of Yentervention, and that would basically, if it is actually 9 trillion yen, which is like estimates seem like that is, then that's basically the combined amount of the previous Yenterventions that they did in 2022. So the interventions are going to get diminishing effects. You have to use more money to get the same kind of effect, both moving in opposite directions. Ever more money, lessening effect, very much like chasing the pink dragon for heroin users and all that kind of thing. So let's see where that goes. But yeah, I don't know. What are your thoughts on that?
Well, I mean, look, like it's what you said. Like in September and October of 2022, I was actually covering this, and I did a piece called "The Sword of Damocles" about this exact dynamic. And at the time, I was worried that the yen hitting the red line and them dumping US dollars to defend the yen would eventually mean that they would start dipping into their US Treasury reserves. And if they started dumping their 1.15 trillion of US Treasuries, that would spike yields in the US and cause, calamity here at home. And so that was what my piece was about.
That would also spike JGB yields too, though.
Oh, well, for sure. Yes, absolutely.
Yeah.
It would be massively bearish for global bonds. But that's what I was concerned about at the time. And I was surprised when after October, right, global net liquidity had basically bottomed, because I mean in that September you had the Bank of England, gilt market blowing up, and then the Bank of England intervening. You had the euro and the pound and the yen all falling to record lows against the dollar. And it seemed like things were finally coming to a head. And then, behind the scenes, Powell and Yellen do their magic. Global net liquidity bottoms and it starts to rise again. The reverse repo gets drawn down. TGA starts to get drawn down. And it seems like calamity's avoided, and we just kind of kicked the can. And so I thought, wow, maybe they can just keep doing this. And then now here we are again, right? This week, 2 more interventions. And it makes me wonder, like, what other tricks they're going to pull out of their hat to try to kick this can.
That's the point, is that they see what our problem, us as an those who are not employed by these central banks. We just think like our only kind of imaginations our menu of options is like what has already happened, what have they already done. But again, as you said at the very beginning, we're talking about like not just Bank of Japan, it really is Ministry of Finance as well, but like this is Japan's global monetary policy and fiscal policy, for that matter, experimentation laboratory. Not by choice, because Japan has to be, because of aging. They have a lead on aging demographics, so they have a lead on national debt levels and all that. So they have to like venture into the unknown jungle and do like crazy things like yield curve control. It literally is the policy experimentation laboratory, as in like Ben Bernanke, ex Fed Chair Ben Bernanke flew over to Tokyo in summer of 2016 and helped design yield curve control, which was then implemented in September. Like literally a experimentation laboratory. So I think that we should not think of like these are the only options just because they could pull anything out of like who the hell knows. Yield curve control came out of nowhere. We like when I remember like when that policy came out, everyone's like, what the hell is this? So I don't know what they'll do next, but this isn't all that they have, I suspect. And so we have to keep our minds open to like maybe they have another trick up their sleeves or another few. What they are, I don't know, but just be open to that is what I would say.
Yeah, and I imagine, we talked about this on the Spaces, right? Like, I imagine that they've had conversations with Yellen, and Yellen's asked that they, or maybe not asked, but demanded that they don't dip into their U.S. Treasury reserves, in which case they only have, their foreign currency reserves and some money in a capital account. And so I guess that begs the question, right? And I think you mentioned this on the Space of how many interventions they have left. And then after they run out of interventions, are they just going to let this thing ride? Are we going to go to USD JPY 200?
So I think that here's the thing. So the kind of the bigger picture of like this question that you've been trying to explore and answer of kind of endgame, if you will. I think that the Bank of Japan is going to be able to keep borrowing costs in check for Japan because they have an unlimited ability to do that, and they've already been, like, let's be frank, the JGB yields do not belong. 10-year JGB yields do not belong sub 1% in this current environment. They don't.
Yes.
Like, if according to market rates. Okay, so that's already going on. They're monetizing debt, and they're not. They can't not do that anymore. And they have their point of no return. So I think that what they're doing is they're going to do that, and then the moral hazard is what they're relying on. The Plaza Accord type of thing, the bailout, if Dalian's at 300, that's like Euro at 60, and like GBP at 60, and that's like global like catastrophe, and it's gonna have. So I think that Japan either is explicitly saying having these conversations with like the Yellens and all that, or they're not, or it's just kind of understood, but. Like if you realize if the yen gets crushed, like it's gonna everyone we're all dead, right? Like we're gonna have to sell U.S. Treasuries, or like people are gonna think that we're gonna have to sell U.S. Treasuries and all. So so I think that's the leverage is that like it's the moral hazard put option for Japan that we're gonna keep doing this, and if the yen really blows up because of dollar strength or because of because policy differentials, like you will come back to us where we're permanently stuck at in the seizing environment. Otherwise, like you're gonna have to bail out yourselves and the rest of us and all that kind of thing. And so, like I think that's what they're ultimately relying on. If they end up monetizing, if they end up owning 100% of the JGB market, and therefore the yen is on its way to 300. Then on its way to 300, you'll have the Plaza, the Honda Accord, where they just kind of get together in the back of a car and they hammer something out, and then they'll just try to stem something. So that's what I think that they're relying on, the global panic, the panic coordination.
Yeah, and that's typically what happens, right? The central banks won't really coordinate policy until things start to break, and then they start to panic and start to decide that they suddenly need to create new programs. And one of the things I postulated, right, in my piece was, hey, like they could open up a swap line with the Fed and just say, hey, we don't want to sell our treasuries. We can't burn through all our currency reserves. Why don't we just open a swap line with you? You can just shore up yen on your balance sheet. We'll get USDs, and we'll use these fresh USDs to hold the line. That could be a potential. Do you think that that's a potential solution?
I think that they have a swap line with the Fed as like a long-standing one. Like I think they always have like they like COVID or whatever, they like announce them, but they like certain central banks, like the major ones, the Bank of England, the ECB, there's an implicit like, we always have swap lines open. But yeah, I could see that happening. But that's really no different, really, in broader concept as like a Plaza Accord sort of thing. It's a resetting of the it's everybody getting together and saying this is terrible for all of us. So it's like 2008 and like all the investment banks, but done at like the
Nation state level,
the sovereign level. Yeah, because you always think like who's gonna bail if Lehman has to be rescued by like the state, central banks of the state. Who's gonna bail out the sovereign, government of Japan? Well, the G7, the G5, they'll be forced to. Is I think what they're that's what the moral hazard is, but I think that's what's gonna. But if they do that, that's gonna set a precedence for other governments, United States. If you want to run deficits and like on all that, it's gonna be all good because look at what happened in Japan, and so we can too big to fail countries. So I think that they'll welcome yes, set that precedence, please, so that we have that available. We're not irresponsible. Look at Japan, so we're just fault. Like they did it before. That's how QE and all of that, all the things that everybody follows Japan with, like. Why wouldn't this also be one of those? So I think that's what they're trying to do. But in the shorter term though, like you saw how fast dollar yen moved. Like it was basically 150 this time last week. So Friday last week, 155 was where it opened. 158 by New York close. Monday of this week, 160, and then smacked back down. And then from that 160 to the end of Friday, we basically cracked back into the 151 handle. This is it's like a meme coin, like the yen at this point, right? But I think that what they're going back to the carry trade thing. I think what they're trying to do right now is also. You ever consider the fact that the Japanese government, the Ministry of Finance, despises the carry trade, despises the fact that the entire world uses the Japanese yen as a short leg of a carry trade. And just everybody's perpetually selling this and that pressure kind of putting on. So what's the enemy of the carry trade? It's volatility. So I think that when you see a 5% kind of swing in dollar yen, which is supposed to be a major G5 currency, but we're trading like a meme stock or a meme coin. I think that they purposely did that this week to introduce volatility, because if you have a 5% yield differential between the United States and Japan, but the currency moved 5%, you just wiped out your carry trade gains. And I think that they're trying to discourage and blow out carry traders that way on purpose to get them the hell off of the back of the yen. That's just my kind of thought. Reflecting on this very historic week of interventioning yet again. But I don't know. What are your thoughts on that?
Well, my thoughts are, I agree with you broadly. I think, they were starting to, right. Coming into this, right, we were seeing yen weakening. I was tracking the action. We cracked 150 in March, and then we were slowly climbing up, and it seemed like just inching. And then this last week with the BOJ meeting, and Ueda, kind of not giving, and FOMC, right? FOMC meeting, not giving any hint at cutting rates anytime soon. That combined with Ueda's meeting and his signaling showed the market hey, this is the time to fucking run with this thing. And I was tracking. I think I saw a tweet that said, hey, in the first 10 minutes of trading, was it Monday morning? The yen popped up 0.25%, which is never before seen volatility, and we're reaching volatility levels seen by by the previous interventions. I was also following another Bloomberg columnist who was showing the realized vol chart, and it was at 27.8, and the previous yen intervention was at 28 and 29, and so we were right there. And right as that happened, we were all kind of thinking, and in the back of my mind, I was thinking, man, maybe they won't actually intervene this time. Maybe they're just going to let this slide and nothing will happen. And then, right as rain, boom, we get slammed down all the way to 155 handle. And then to get slammed again just 2 days later, basically.
Yeah, that second one right after FOMC. After FOMC. That ballsy. But I'm not surprised at all. Why? Well, of course they would do that. They did it. They did the first intervention right after a Bank of Japan meeting as a catalyst. This was in September of 2022. Why not after FOMC? Why not take advantage of that? Because they let it go so far. They let dollar yen go so far that if each Yentervention is getting them a 5 handle drop in USD JPY. That's fine if it's like if you're trying to like protect like it go to break out into like the 140 handle and you drop it down to 135. But from like if you're starting from 160, you drop it down to 155. Hooray! You dropped the 5 handles, and you're at 155 still. So like the more you like let it go, and you can only get them in 5 yen increments. I mean, they have to just keep hitting it down. To the credit, they got it down 10 big figures in a week. Let's see if that lasts. It likely won't, but they do have to kind of do them in succession, and I think that they're trying to. Same thing with the the BOJ with their kind of purposeful ambiguity. They're learning, I guess, the very stupid and hard way, but they're learning to be as purposefully ambiguous as possible. If I were them, I would just do 2 like kind of right in a row, like like one in the morning, one in the afternoon, just so people have no idea when and how much, and like at any time there's no speculation of lines in the sand, of levels of volatility. Like no, like we are crazy people. You don't know when we're going to attack, so just stop short of the end. Like that's what I would be doing if I were them. Just because if you're gonna do it anyway, just do it in a non-predictable fashion and get that leverage. Like learn something from the BOJ. But that's I don't work there, so I'm not a minister of finance, intervener. So I can't speak to that. I can all I can do is just try to figure out how they think, and yeah, and like the space is the point that I wanted to make about that. The most important thing was that the biggest fear that they have, that the Ministry of Finance has, the reason that they've been dragging their feet, and the reason that they really hate doing interventions is the fear of the worst thing that could happen is if they do a intervention and it fails, as in you get dollar yen to fall 5 hands, 5 big figures, but then it comes right back up, right? Because if that happens and markets realize like, oh my god, this doesn't work anymore, then the yen really gets destroyed. And then they can throw any amount, they can throw whatever they want at it, and it's not gonna work. So at least for now, like they kind of have the fear instilled in markets of like intervention and all that, and getting burned if you short at like the lows, but they're kind of not, they're losing that credibility, but they really, that's what I think they really fear. That they think they saw what happened with March BOJ, how dollar yen just didn't care, just kept on rising, even though they just did this historic rate hike out, it was negative. And they see that, like, rightfully so, they see that USD JPY is on autopilot upwards. And what happens if we have a failed intervention? And the risk of having a failed intervention is much worse than the current state of a slow death JPY. That's a luxury. So that's why I think they were dragging their feet. But then when you have JGB yields start to rise up towards those kind of levels, that's why you have Ueda basically just going out there saying, like, currency issue? What are you talking about? Type of like ridiculous, insane thing. And brushing off JPY weakness. And then you have the following, week Ministry of Finance coming in and actually doing these interventions. So look out for whether or not, not necessarily that they're failed interventions, but if the Ministry of Finance might perceive them as failed, because then they're gonna throw the fucking kitchen sink at it, and because it's like do or die. So we're not just because this week is over, we're not done with the interventions. Just so you know, we're in the midst of them. Right, it's still going on until it's not anymore. So that's what I would want to drill home.
Yeah, I mean, I'd be curious, right? Like, do they have access to the exchange data and they can see where the shorts and the and the futures are at, and then they can try to just basically stop loss hunt, with these interventions, so to make them as effective as possible.
That's what rate checks are. That's what the rate checks are, like the way that it works is like the Bank of Japan. Okay, so the Ministry of Finance gives the order to the Bank of Japan, like, all right, go intervene. And the Bank of Japan makes their calls around to like the different dealer desks around in Tokyo, mostly domestic. And they just get market color and they see where there's pockets of like illiquidity. Like people when they did this on Monday, that was a Japan holiday. Obviously the FX dealers were not on holiday. We're not taking vacation with dollar yen at 160. And so yeah, they basically call around and if they see like there's illiquidity, that's a good, that allows them to make a bigger move using less capital to have to push the market that way. So that was actually would make sense to do that. Same with doing it right after FOMC when nobody's towards the end of the day when catch people off guard. And so that's how they definitely have as best market caller as any institutional desk does, that they kind of aggregate together. I was talking to somebody who worked at one of the major the mega banks, and they were telling me about how there is a section of the trading floor where there are traders who their only job, their sole client is Bank of Japan or the Ministry of Finance for FX, for like intervention and all that, and they might never get a single fucking phone call for like years, but you better be on the desk if and when they call and blast the market. Like that's the soldier. And there's like a line. There's literally like a line across like the floor. Like you do not, like traders, the rest of you guys, private sector traders, you do not cross. You don't talk to those people. You don't know their names. All that kind of thing. They're like super strict about that. But it's got to be the worst job ever. You're just like sitting there like. But when that phone call comes, yeah, you better be ready to provide them like with everything you got. Like, yeah, and I'm sure they're giving up like all kinds of, this hedge fund's doing this hedge fund's this, there's a stop loss, here's where they're gonna get stopped out, here's this, like, of course they are. So I think that they people need to give them more credit as like currency traders, as in they have more information than anyone else would normally legally be privy to.
And I'm sure it's they don't have to worry about any of those insider trading laws or any of those typical pesky regulations that would stop a normal entity from knowing that information.
Sorry, I missed that. I missed what you said after. I'm sure it's, and then you froze up.
Oh, I said I'm sure that they don't have to deal with any of those pesky laws or regulations that most of the normal market participants have to deal with, right? They don't have to worry about this being insider trading. Yeah. Yeah. Exactly.
Yeah. They're policy leaking to like they're leaking material non-public information to the Nikkei of upcoming policy releases on the day of Bank of Japan meetings, and like they clearly don't play by their own rules. And as they shouldn't, I suppose. But yeah, they of course they're gonna see all the color and all that kind of thing. Like if you don't tell us this, we're going to threaten you with like, if you don't not comply with the law, bank that I'm calling right now, then you're going to be in trouble.
Yeah,
that's the beauty of being a regulator, right? Yeah, so
exactly. You could take away their primary dealer status, which would be horrible for them, right? And so they don't want to lose that.
We'll take away your primary dealer status. Oh, so we don't have to buy JGBs anymore. We're not forced to. Well, I mean, we'll make you even more of a primary dealer. All right. We'll cooperate.
Do you think so? A couple more questions for you, but do you think that there's anything they can do, besides obviously they can't really hike rates? Is there anything they can do to stop the carry trade? Can the Ministry of Finance put out, restrictions on, yen loans that are going to be used in international finance? Can they ban investing in U.S. assets if you take out a loan in yen? Is that possible?
I suppose they could do that if they want to start to look more and more like China than what's supposed to be an international, free market participant of the global order. Yeah, of course, they could do any of those things, but comes at a cost, reputational costs, all that. They're burning a ton of reputational costs right now. The yen, like dollar yen or the yen in general right now is not a. It really, like when I say it's a meme coin, like I really do mean it in the sense that this is not a G5 major currency. It is a clearly, openly manipulated, top-down, controlled, at least attempt controlled, non-fundamental burst of volatility based on a handful of unelected officials and policy positions doing things out of politics as well, of motivations, and I mean that's what the yen is, except unlike a meme coin, it has implications on things like the risk-free United States Treasury rate and all that. So Yeah, they could do like anything that you might think of. Like, can they possibly do that? The answer is like, yeah. And the only question is, what's the trade off? And if they feel like they can achieve whatever their goal is, as they see it, and the trade off is worth it, then they have no problem with like protocol and norms and all that. It's very non-Japanese, ironically, in that sense.
And what do you think are the knock-on effects
and
of this?
In terms of like what's that?
Oh, no, finish the point. Finish your point. I have another question.
Oh, I was gonna say, and then so in terms of like ending the carry trade, I think that like you're seeing that happen right now, or attempting to, like just create volatility. You have Finance Minister Suzuki out there every day saying volatility is undesirable. When he says volatility, he is talking about one directional downside in the yen. That's not volatility. Volatility is two directional swings. So it's ridiculous for him to cause volatility by citing unwanted volatility. It's a very nonsensical thing to say, unless he knows exactly what it is that he's saying and what volatility means. And so he'll say unwanted volatility, but he'll create volatility so that he can blow up this despised yen carry trade. The fact that why does the yen have to be like we all know why, but like they hate the fact that the yen is used as the go-to sell leg of the carry trade. So I think that he's trying to flush that out, and I think that that's what you're currently seeing right now. To answer your question, the answer to this question right now is just look at this past week, I think, and potentially what we're in the midst of. Because like I said, it's not necessarily over. So.
Yeah, we're still really in the midst of it. I mean, we've had two interventions this week. We're going to wait to see what happens next week with price action and as people that just post FOMC. What do you think? I was going to ask, what do you think are the knock-on effects of this in regards to other currencies? I've been seeing, just 2 days ago, the chief of the Bank of Korea came out and said that he was warning against excessive volatility in the yuan. We've seen multiple Asian currencies hit decade lows. And then there's been speculation that the Chinese yuan or the renminbi is the next to face, pressure to devalue. And that Beijing is going to have to decide if they want to, devalue and try to add some, some export ability to their country, or if they want to try to hold their line at, 7 and change to the dollar. What do you think are like the regional implications of this?
I'm glad you asked me. Here is what is happening regionally. That is dollar. That's the meme coin called dollar yen.
Yep.
Fucking insane. Okay, this is regionally. Korea and China are on the sidelines, rooting on the Ministry of Finance and Yentervention, because look at what the dollar's been doing, like you said, year to date. It's crushing, like EM is crushing Asia currencies. Look at what Ministry of Finance is like doing, fighting back, and look at who gets to benefit and like ride off the coattails of that. You get yuan strength, you get KRW strength, along with the JPY strength. So Asia currency, and it's not just like these three either. It's across Asia EM too, but they're cheering Japan on. And then actually just a few hours ago, or overnight for us, in Asia, you have a joint statement out of the is it the G7? I don't know. I don't know if it's the G7, but they're meeting in Georgia, the country, not where the peaches grow in America. But you have a joint statement out of Korea, Japan, and China about concerns about excessive volatility on their respective currencies. So they're all like, they're loving this, Like, what are they going to say? Like, Japan, you're a currency manipulator, and you're making us like, we're like China, we're Korea, we are major trading partners with you, and you are manipulating currency, and it's making it like less competitive. Yeah, that's an issue, but like right now they're all respectively China, Korea, everyone else, their currencies are getting crushed. So if Japan can like meddle and like break from like being a normal G7 or G5 like protocol and all that, and therefore pull down USD for everyone else, they'll take that in the immediate, and worry about trade later, and competitiveness and all that. Those are just two different time horizons and priorities. So, so the impact of this, as right now, as long as like USD JPY falls, it's going to pull down these other Asia currencies as well. And if USD JPY blows up to the upside, you're going to see dollar CNH and USD KRW and the rest of them also move up too. So they can intervene. The other ones can intervene as much as they want, but like really Japan is the one that can really do it. And for that matter, China, they intervene in the currency every day. I mean, they fix that's just by nature of the fix to the dollar. So that's intervention. But so like when they say like China's also stepped in to intervene, like, but that's what the peg is. So but yeah, KRW, that's been an issue, but they also had the other trilateral statement coming out of G7 in DC from 2-3 weeks ago, in which they actually had in writing the U.S. Treasury kind of explicitly giving a wink wink nod nod or a green light to like go ahead and intervene sort of thing. And Korea has been also talking very not as like forcefully aggressively as Japan has, but yeah, like this is now becoming like everybody's issue, and so Japan has kind of everyone's blessing to break from any currency manipulation labels and or protocol, and just blast tens of billions of dollars at market, because it'll save the because they get to ride off of those coattails and not have to dip into their own respective reserves to do so. So
yeah, they're able to, because they're all all those currencies are cross correlated, that they can kind of just ride on this the steam of the Bank of Japan as they plow their way through the FX market, right?
No,
so
it's true.
It's
true because if it's the same. It's no different from Japan has been an anchor on yields globally. They would be much higher if not for Japanese yields being so low, because Japan is the largest foreign fixed income investor. They're in your bond market wherever you are, and so it's kind of the same thing. Like everyone's like the Bank of Japan. Like what I say is about yield curve control is that when you're pushing trillions overseas out of Japan in search of yield, the Japanese are cash rich, yield starved. They're looking for yield elsewhere because there's none at home. What that does is that is yield curve control, indirect yield curve control, like on the U.S. Treasury market, on like other global bond markets as well, right? Like it doesn't happen in a vacuum. And so by that nature, like it's really is like Bank Japan is almost the enabler of allowing Congress to run up like insane deficits year after year after year and all that kind of thing. And like they certainly are sharing a part or are contributing to that, right? And if maybe if the Bank of Japan wasn't doing what they're doing, or that didn't even exist, maybe that would be a fiscal check. But it's not. It's just absent the Bank of Japan, the like global yields would be much higher, even though they have been blasting higher over the last few years. So in that same way, why not ride off the coattails of Japan's currency intervention as well? Japan has no problem being non-capitalist, non-free market, and other countries have no problem with them doing that if it benefits them as well for free.
Yeah, I mean in the short term, right? But what about the long run? Because if Japan runs out of these interventions and we eventually see yen to 200, or even 250, as Brent Johnson and some other people hypothesized, does that mean kind of a rerun of the Asian financial crisis? The 1997 Thai baht breaking the peg and the central bank failing to defend, and then the rest of the Indonesian rupee and the rest of the Asian currencies all kind of falling in tandem. Could that be in the cards?
They only cared when they as in like the West really only cared when it actually hit Korea, because they were deemed as like, oh shit, an important country. Because everyone was brushing up. There was not Davos, but there was some sort of conference in Hong Kong as that was going on. And they were like, nah, this is no problem. Like, they're in the region. They're physically in the region. And there's like, no, it's not like Larry Summers and all that brushing it off. And then they're like, oh shit, it's a problem because one's in Korea. Yeah, but this is what I was just saying before. Like, this is the moral hazard put that the world and Japan is probably relying on. Like, there'll have to be some sort of like kind of, there'll be like, you want another Asia financial crisis, but like much worse, like and much more global in contagion and much more sort of fast spread. We already have precedents for that, like because of LTCM and all that, and the culture of bailing out, like, deadbeat, be it states, nations, or banks, or whatever, or companies. That's a culture anyway, so why the hell not? And so, like, I think that's the moral hazard that they're relying on. It's that put option. So I think that Japan is, I don't think that it won't get to that. Well, I don't want to say that. I probably won't get as to that level of like terrible, because there'll be that safety net put option by forcibly so by global coordination to fix things and reset everything. So I think that dollar yen 200. This is what I'll say. Dollar yen 300 is more likely than dollar yen 200. Meaning, dollar yen 200 is a weird purgatory thing. Dollar yen 300 means what I just said about like that global coordinated put, that moral hazard put. That didn't happen. But on the way there, it'll be, slammed back down and reset and all that. And so that's why I'm saying like 300, dollar yen 500, that's more likely than like a 200, 250. If you get what I mean. I don't mean like those exact levels, but like, you know what I mean? Like that kind of in between level doesn't really exist. Because it wouldn't, because they would be the policy step in and save, or it would be none of that and just off to the moon for USD JPY.
Got it. Yeah, it's either the US steps in and opens that, funds that swap line and really make sure that they're flooded with US dollar liquidity and can stay,
or however they do
where
it.
They are. Yeah, or whatever the program they create, or
they say fuck
they
it,
just
you're
say.
Yeah,
they throw away the paddles on the boat and just push them out to sea and say good luck, guys. Yeah,
I mean, like that's why it's that's why I'm saying like dollar 300 400 plus would be more likely than 200, right? Like just because like that in between thing, it's the market's not just gonna sit around 200. Like it's just it's not gonna find fair value there, right? So
yeah. Exactly. Do you have any other charts you wanted to share? I know that you had like...
I do this for everything. For my previous podcast, Market Depth, for every single sort of subset. The why you should care. Here is why you should care. That is the United States risk-free rate. That is the most important price in the world. That is basically every single sort of financial asset is in some way or another to differing degrees priced off or based off of this. This is USD JPY. And then in the same way that I was talking about yield curve control bands being lifted and 10 US Treasury yields breaking out to the upside, and the way in which they did for 2023, for this, so dollar yen 152, that was very, very sort of solid, formidable upside resistance on dollar yen, because that was the previous October 2022 Yentervention highs that you could see just very unnaturally, like dollar yen was like on its way up and up and up and up all throughout the year, and then suddenly just hits the ceiling and all that. Well, U.S. Treasury yields also stopped around there too, and then they also broke out at around the same time, and they also kind of pivoted around the same time as well during this week of Yentervention. So, coincidence? Maybe. Likely not. So, that's why you should care. In case dollar yen and U.S. Treasury yields and their incredibly tight correlation still exists. If you see crazy like swings like that, you're gonna see crazy swings in Treasury yields. And if you don't, that'll be a very interesting potential trading opportunity, but that's neither here nor there. Either way, because dollar yen and in the most important price in the world, 10-year risk-free rate, has historically been almost tied, like attached to the hip in terms of price action. You need to watch dollar yen go from 155 to 160 back down to 152 in like the matter of like 3 days. So yeah, that's the why you should care. Yeah.
Awesome. Well, thank you so much. I don't want to take too much more of your time, so we'll wrap up here. If people want to follow your work, where can they do that? What's the best place for them to find you?
Sure. So most of my kind of, my thoughts, all that, I just publish out on Substack. So I don't know if I can give you a link, but if you go to acrossthespread.com, you can find links for all that. I also have, YouTube channel and Twitter at Across the Spread. Basically everything is at Across the Spread. So you can find me there, and yeah, I'm happy to do another space with you. That was fun. So you can find me there as well if you'd like to host me again.
Sure. Yeah, I'll put the links to all those things in the description. Great. Thanks again, Weston, for coming on. This was an amazing episode, and I'm sure that everyone will have a ton of thoughts and ton of insight from it. So thanks. We'll definitely do this again sometime.
Thanks a lot, PB-san, and I appreciate your your enthusiasm and your kind of, you're very necessary, but you're very insightful hunger for this particular topic and being on top of it. I very much respect you for doing that. I used to tell people all the time, like, I would be like, it's a coincidence that I'm in like on the ground in Tokyo. I would be looking at the Bank of Japan if I was trading out of Brazil or Norway or whatever. Well, you're actually that person, so good for you. So yeah, keep it up.
Thank you. Yeah, I'm in Colombia, and I'm keeping up with everything that's going on with the Japanese yen, just following the price movements, and I have price alerts set. So I'm right there with you, just 12 hours behind or whatever.
Markets are real time, so it doesn't matter. But yeah, I take your point. But yeah, thanks a lot for having me too. I appreciate it.
Awesome. Thanks so much, Weston. We'll see you later.